In this video, we're going to have a look at sources of finance. We're going to have a look at 6 different options businesses might use, either to help them out with liquidity problems or to raise larger sums of money for capital expenditure projects. So we're going to have a look at the differences between each, and we're going to try and ascertain what the advantages and limitations are of each one. And we'll start with debt factoring. Great source of finance, this. Debt factoring is where if you are owed money by one of your customers, one of your trade receivables, we should call them, but you can't afford to wait. So your business is perhaps suffering some kind of short-term cash crisis, some kind of liquidity problems, and you've got a big order from a customer that's still waiting to be paid, but you can't afford to wait for that customer to pay up anymore. You can sell that debt onto an organization known as a debt factoring company. So imagine you've got a trade receivable for £100,000 and it's coming to you in 3 months. So you know that in 3 months' time, one of your major customers is going to pay up £100,000. But you need cash now. You need cash this month in order to meet your own financial commitments, maybe pay your own suppliers, your workforce, marketing, whatever you might need the cash for. You can sell that £100,000 debt that you're waiting to receive to another organisation, to another business. Now, they won't buy it from you for its full value because they're going to make a profit. That's how debt factoring organisations function. They make profits by buying debts from business for less than their full value. So they might pay you £80,000 for this debt that you are owed. Now, they can afford to wait for that debt to mature. They can afford to wait the full 3 months. So they will buy it off you for £80,000, but then get paid the full £100,000. But for your organisation, it means that you get cash now, today, when you need it. So you won't realise the full £100,000 that you are owed, but it brings the cash into your organisation that you need now to solve your own liquidity crises. So obviously the advantage of this is that it allows businesses to release cash when they need it in order to solve their own liquidity. The downside is that you are missing out on the full value of the sales that you have made by selling that debt onto a debt factoring organisation. Still a very useful source of finance though. A short-term source of finance that often bails businesses out is what's known as an overdraft. Now, an overdraft is a facility that businesses can arrange with their banks, so they have it on their bank accounts. And essentially what an overdraft allows a firm to do is to spend even when they have run out of money. So an overdraft is almost like an extension onto your bank account, so that as your bank account almost reaches zero and you don't have any funds left in there anymore, if you've arranged what's called an overdraft facility, the bank will allow you to spend beyond the money that you've got in your bank account up to an agreed limit. So small businesses might have overdrafts for, say, £5,000, £10,000. Larger organisations might have overdrafts agreed for hundreds of thousands. Large PLCs, perhaps even millions of pounds. So that as they start to run almost down to zero in their own bank accounts, they can carry on spending up to the limit that they've agreed with their bank. Now, obviously, the advantage of this is that it allows businesses to continue purchasing the assets that they need for their organisation, even when they don't have any cash of their own. They can start almost spending the bank's money. The downside is that you have to pay to have an overdraft facility. So every month that you use your overdraft, you go beyond your bank account limit of zero and into the bank's overdraft facility, you get charged a fee. And the interest on these fees is much larger than you would pay even if you were borrowing from the bank in the form of a bank loan. So overdrafts can be fairly expensive ways of borrowing money, but they are a great, almost like safety net for organisations so that they can carry on meeting their financial commitments even when their own bank balance has gone down to zero. A wonderful source of finance that businesses might use is retained profit. So at the end of the financial year, when a business has calculated how much profit it has made for the period, there's 2 things that they can do with it. They can distribute it to their shareholders, in which case it leaves the organisation, or they can choose to apportion a percentage of their profits to retain in the business for spending on growth and expansion and development. Now, the major advantage of retaining some of your profits in the organisation and using them on your business to grow is that you don't have to pay any interest on that money. It's an internal source of finance. It's raised by the organisation itself. So it doesn't require paying back in any way. But the downside is that is money that you are then taking away from your shareholders. Technically, your shareholders might be looking at those profits that the organisation has made and thinking that they are entitled to all of that all of that is going to get rewarded amongst the different owners. But by retaining some of those profits, you're taking that money back out of shareholders' hands. Now, short-term shareholders that are looking for quick returns from the organisation might see too much retained profits as a signal to sell their shares in the business and go and invest elsewhere. However, your longer-term shareholders will probably look favourably on the use of retained profits if it's a signal that the business is using it to grow and expand and the dividends in years to come might be even larger. Now, a major source of finance for organisations when they're looking to raise quite large sums of capital, when they're looking to raise money for growth and expansion and the development of the organisation, is to use what is called share capital. So that is bringing new owners into the organisation in return for giving them a stake, a percentage, a share of the business's ownership. Now, one of the advantages of this method of finance is obviously it can bring in quite large sums of money. In return for a stake in the organisation, people may be prepared to pay quite large sums. In addition, those shareholders that join the organisation, in LTDs at least, might bring with them some industry knowledge, some expertise, some experience of being involved in businesses, and might even bring contacts that they have in the industry that can aid the business. The limitation of it is that bringing in that finance and bringing in that expertise means relinquishing some of the control of the organisation. Some shareholders may not want to be involved in the direction of the organisation and are happy just to pick up a dividend. But other shareholders may expect to have some say, so they can almost direct the organisation now that they've got a stake in it and now that they've got funds that are tied up or are at risk in this organisation. So it can lead to the original shareholders in the organisation having to relinquish some of the power and the control that they have to involve and look after the needs of these new shareholders. A very popular source of finance is to seek loans from financial institutions like banks and building societies. If it's for property, this could be in the form of a mortgage, which is a loan just to secure office space, factories, warehouses, whatever kind of sites the businesses needs. Or it could just be a bank loan to invest in IT or vehicles, machinery, whatever assets the business is looking to procure. Now, bank loans are advantageous because you can raise significant sums of money from bank loans. And it's a formal agreement with the organisation with structured repayments that the business can plan for, that the business can include as part of its cash flow forecasts. So the business can really plan years into the future how much they're going to have to repay on this bank loan, and they can monitor it and manage it. The limitation of bank loans is obviously that they have to be repaid back with interest on top. So if you borrow £100,000 in order to invest into your business in the form of a bank loan, you will end up paying that £100,000 back plus an agreed rate of interest on top. So it can be an expensive way of raising finance for your organisation. However, you contrast it to something like share capital, and a bank loan means that you don't have to relinquish any of the control of your organisation. So paying interest may be something that's preferable to you rather than involving new owners in the organisation. And you contrast it with something like retained profit, and a bank loan means that all of your profits then can be distributed to the shareholders to keep them sweet. So again, it might be a preferable source of finance. Final source of finance we can bring to your attention is venture capital. Now, this has crossovers with both bank loans and share capital here, because venture capital can come in two forms. Venture capital means involving other entrepreneurs, wealthy individuals, sometimes we call them business angels, and inviting them to invest in your organisation. Now, that can come in two forms. First of all, business angels might want to invest in our business in return for a share of the ownership of that organization. So it works just like selling share capital in the business. And business angels will absolutely, rather than be silent partners, want to be involved in our organization, bring us their knowledge, bring us their expertise, bring us their industry contacts. So one of the advantages of using venture capital to raise finance is if they take a stake in the organization, they will bring a lot of expertise that your business can utilize. There are instances where we might use venture capital, so money from rich, wealthy, successful entrepreneurs, that doesn't actually involve selling a stake of the organisation. Rather than taking loans from banks, we might find wealthy individuals or venture capital organisations that are prepared to invest in our business. Now, sometimes venture capital loans are used by businesses when they might have been rejected by banks. They might have been turned down for bank loans, especially if they're new organisations, but they might be able to find venture capitalists that maybe are prepared to take a higher risk in investing in a new business than a bank is prepared to take and lend the organisation money. And again, that loan from the venture capitals will come with expertise and advice and support and industry contacts. However, borrowing from venture capitalists often involves repayment at a higher rate of interest to compensate for the fact that you're perhaps a more of a risky organisation to loan money to. So venture capital is great in that you are borrowing money when you've been turned down from a bank, or it's great that they might be buying a stake in your organisation, they can bring you expertise and advice and support and knowledge, but you're either going to have to pay them a dividend and involve them in the ownership of the organisation, or if it's just a venture capital loan, the rates of repayment may be higher than bank loans might be. So there's our 6 sources of finance. Very common that we might get asked questions about these sources of finance in our business A-level exams. Hopefully that gives you the lowdown on each. We wish you luck with your ongoing revision. See you soon for another tutorial.